A credit score is a number that represents your creditworthiness, essentially, how reliable you are when it comes to paying back borrowed money. Lenders, like banks and credit card companies, use this score to decide if they should lend you money and what interest rate they'll offer. In simple terms, a high credit score means you're considered a low-risk borrower, while a low score makes lenders see you as a higher risk. Credit scores typically range from 300 to 850. The higher the number, the better. A score above 700 is usually considered good, and anything above 800 is excellent. Scores below 600 might make it harder to get approved for loans, or might lead to higher interest rates. So, the goal is to keep your score as high as possible to get better financial opportunities. Your credit score is calculated based on 5 main factors. Payment history. This is the biggest factor, making up about 35% of your score. Lenders want to see if you pay your bills on time. Late payments, missed payments, and defaults can lower your score because they signal that you might not always pay back what you owe. Credit utilization. This factor looks at how much of your available credit you're using and makes up about 30% of your score. If you have a credit limit of $1,000 and you're using $900, your credit utilization is 90%, which is high. High utilization can lower your score because it suggests you might be over-reliant on credit. Ideally, you should keep your utilization below 30%. Length of credit history. This factor makes up about 15% of your score. Lenders prefer to see a long history of responsible credit use. So, if you've been using credit for a long time and making on-time payments, it can help your score. New credit users might have lower scores because they don't have much of a track record yet. Types of credit used. This part, which makes up about 10% of your score, considers the mix of credit you have. Lenders like to see that you can handle different types of credit responsibly, like credit cards, loans, or mortgages. Having a good mix shows you can manage various financial responsibilities. New credit inquiries. The last factor, which is also 10%, looks at how often you apply for new credit. When you apply for credit, lenders do a hard inquiry on your credit report, which can slightly lower your score. A few inquiries won't hurt much, but too many in a short time can make you look risky. Let's go through an example. Imagine you're applying for a car loan. The bank will check your credit score to see if you're likely to pay back the loan. If your score is 750, that's considered good, so the bank may offer you a low interest rate. But if your score is 580, the bank might see you as a higher risk, so they could charge you a higher interest rate, or they might deny the loan altogether. Improving your credit score takes time, but it's doable. Start by paying your bills on time every month, even if it's just the minimum payment. Try to keep your credit card balances low and aim to use no more than 30% of your available credit. If you're new to credit, consider opening a starter credit card and using it responsibly to build a good payment history. And finally, avoid applying for multiple new credit accounts at once.